September 2021, question number 1. 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 The one that reads H. It's a H, SA. H is the holding company subsidiary, and then A. Do we have that question very fast with us? Do we have the question? 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 HSA. They are not talking to me. We had begun doing this question yesterday, remember? We had begun doing this question yesterday. We began doing this question yesterday. You have it. The one that is called the HSA. Humphrey, yes. So at least 2 students have it. So we are told there, on 1st October 2019, H Limited acquired 80% of the ordinary shares in S Limited. So we have H acquired 80% of S. So H acquired 80% of S. This 1st October 2019. Very important for me to mark my dates. So, ladies and gentlemen, we are told here on the same date, H Limited acquired 40% of the ordinary shares in A Limited. So H went ahead in this case here to acquire 40% of A Limited on the same date. This is 1st October 2019, like that. 1st October 2019. Now, ladies and gentlemen, given the percentages, of course, S automatically becomes who? S becomes a subsidiary. Because 80% is so big. If you're using the percentages, this is control. This control. 80% is so huge. And then we have A, we only acquired 40% of A. 40% is between 20% and who? 50%. So meaning that here, we only have significant influence. There must be another bigger brother who has 60%. The one who has got 60% is the one, in this case, who has got what we call a controlling stake. So not unless you're given some compelling reason to believe that even with 40%, this guy can exercise control. You know, at times they'll tell you that, fine, this person has got 40%, but he has some right, which gives him the powers to appoint like all or substantially most of the directors. So at times they tell you the percentage could be small, even 10%, but they give you something to show you that, hey, H is still holding what here? Control over A. So this one automatically is an associate. So A is an associate. A is an associate. A is an associate. So the gentleman, the moment I read like that, what I will do very fast here, I've known the subsidiary, I've known the associate. I will go to the pro forma statements. I'll go to the pro forma statements. The pro forma statements, I'll copy them the way they are. I'm copying them down the way they are. So I'm copying down these the way they are, all of them. So all of them, so I'm copying down, I'm copying this down. So what do we have here, ladies and gentlemen? So I will come and write here. This is, they want me to give them, if you look at the requirement, they want me to give them the consolidated statement of profit or loss and the consolidated statement of financial position. So we have here consolidated P&L. The name of the group is H Group. So I'll simply copy down the items there. So like now I have revenue. I'm simply copying down everything the way it is there. I have revenue. I have in this case here cost of sales. Then we have in this case here gross profit. You copy everything the way it is there. So long as you've seen you have a subsidiary, you copy everything. We have distribution costs. Then we have administrative expenses, administrative expenses. Then we have, in this case here, investment income. Investment income, you simply copy down everything the way it is there. After investment income, we have, in this case here, finance costs. Finance cost. After finance cost, before profit stroke loss, before tax, we are advised always, because we have an associate, we have what we call share of PBT of associate. It's important that you introduce this. Share of PBT of associate. And then, of course, now you'll be able to have the profit stroke loss before tax. Talk of profit before tax. Profit before tax. After that, you give us the taxation. You give us the taxation. After that, ladies and gentlemen, just give us PAT, profit for the year, PAT, like that. You start by copying that down. Ladies and gentlemen, remember that this subsidiary, we bought this subsidiary on which date? We bought the subsidiary. The subsidiary was bought on 1st of October 2019. 1st October 2019. And then we have, in this case, the date of the financial statements. If you look at the financial statements given, they are dated 31st March 2020. They are dated 31st March 2020. Who can count for me the number of months that have passed after acquiring this subsidiary? After the subsidiary acquisition, how many months do we have? So we have the whole of October, November, December, January, February, and March as well. So that's 6 months, 6 months. These are very important for my operation like that. All right, 6 months. So then straight away, we have our revenue. So our revenue, what do we have here? We have 25,200 plus the subsidiaries revenue. Subsidiaries revenue, we have 18,000 there. But now this 18,000 is not all of it ours, because we stayed with this thing for 6 months. So times 6/12. Usifanya adjustments bado. Don't do any adjustments at all. All right. So cost of sales, what do we have there? I can see, of course, we don't consolidate the associate. Associate figures are never consolidated. We only consolidate the holding company and its subsidiaries. So in this case here, that column of A, that's an associate. That column, I'll ignore it. I'll ignore that column. So cost of sales, we have here 15,120 plus 12,000. 12,000 again times 6/12. Gross profit will leave space there. Leave space here. Leave space there. Leave space there. We shall be getting that later. Distribution cost, I can see 1344. 1344 plus we have 840. 840 has to be prorated. And remember the proration, we only prorate the figures of who? The subsidiary. We only prorate the figures of the subsidiary. We don't prorate these. Don't put a bracket here. No, this one is only affecting this 840. Then we have administrative expenses, 2196. 2196 plus 1080 plus 1080 and 6/12. Then we have investment income. Investment income, of course, I'll be doing adjustments later. This is 330 plus 0 times 6/12. I'll be doing adjustments later because I know part of this investment income is coming from who? The subsidiary. It's coming from the subsidiary. It's coming from the subsidiary, which has to be adjusted. Then we have our finance cost. So finance cost, what am I seeing there? 220. Finance cost, I'm seeing 220. 220 plus 150. But 150 belongs to the subsidiary. It has to be time prorated. Share of PBT. Share of PBT. Share of PBT. The profit before tax, profit before tax, profit before tax, profit before tax, or profit after tax, it doesn't matter. So in this case here, profit, this one you can leave it later. You can leave it and do it later. This one you can do it later. So ladies and gentlemen, after that, I can see the income tax. Income tax, what am I seeing there? 1,800, 1,800, 1,800. 1,800 plus 1,200 plus 1200 times 6 over 12. Wacha nao namna hiyo kwanza. Kutoka hapo, wacha tu space ya kutosha. Wacha space ya kutosha. So this is number 1. I'll be doing in this case adjustments later. And then number 2, part 2 of this question, they want us to give them H group. H group. In this case here, consolidated statement of financial position. H group. H group. H group. Consolidated. 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 Consolidated statement of financial what year? Position. Of financial position. So don't do any adjustments at all, because if you go this approach, you'll end up getting so many marks without knowing what you are doing, without knowing what you are doing, without knowing what you are doing, without knowing what you are doing. Okay. So in this case here, ladies and gentlemen, we start with non-current assets. So non-current assets, I'm simply copying this thing the way it is given there. The table they have given us, the statement of financial position they have given us. That's what I'm doing. I'm simply copying that. So under non-current assets, what do I have? Non-current assets, what do I have here? So non-current assets, I have a PPE, property, plant, and equipment. So property, plant, and equipment, I have investment in A Limited, investments in the associate. This is very good. And then, of course, we have some other special investment. We have invested in a subsidiary, but we can't talk of investment in subsidiary because subsidiaries are ourselves. Remember, subsidiary is part and parcel of us because we are controlling. But there is something, whenever you hear of investment in a subsidiary, there is something that should be able to replace. We have in this case here what we call goodwill. We have what we call goodwill. So this I'll be doing later, all right? Then I have financial asset. Financial asset. I have financial assets. So that is it for non-current assets. So we go to current assets. So we go to current assets. So current assets, what do we have here under current assets? We have inventory. We have inventory. We have inventory. Inventory. We have receivables. We have receivables. We have receivables. We have a cash and cash equivalents. Cash and cash equivalents. From there, we go to equity and liabilities. So we have here equity and liabilities. So equity and liabilities, we start with ordinary share capital. So we have here ordinary share capital, ordinary share capital, ordinary share capital. After ordinary share capital, I have share premium, share premium, share premium, share premium. After share premium, I have retained earnings, retained earnings, retained earnings. And then don't forget, ladies and gentlemen, to bring LCI here. Because LCI, these are third parties who have given you, these are third parties who have given you permanent capital. They're not coming for this money. So it's part of equity, non-controlling interest is part of equity. So NCI is part of equity. NCI is part of equity, so we put it there. From there, we go to the non-current liabilities. Non-current liabilities. So we have the non-current, because of space, I can avoid writing the non-current liabilities here. Title, I can just mention here, 8%. I have to write non-current liabilities. Non-current liabilities, what do we have here? We have 8% loan notes. 8% loan notes. 8% loan notes. Leave it there. And then remember, we had read this yesterday. We have the deferred consideration. These guys made a promise of paying some money later. We have the deferred consideration. And then after that, we have current liabilities. So we have the current liabilities. You're simply copying the table, the entire table, the way it is. So current liabilities, I have payables. We have payables, and then we have tax payable. We have tax there. So payables and what here? And the tax, payables and tax. Have you guys managed? I know my writing today is very poor because I'm trying to squeeze, but have you managed to write up to where I am reading? Have you managed to write everything like that by just by squeezing and seeing those items even better from Yes, thank you very much. So for the balance sheet, we don't prorate figures. Balance sheet, don't prorate figures. You're going to add directly, you add directly. So for the balance sheet, what do we have here for the balance sheet? If it's PPE, we have 25,000. 25,000 plus 16,300. Plus 16,300. Investment in A. Of course, I'll be doing this working later, but I can just book the figure. This investment in the associate, I'll be doing some workings later, right? Goodwill, I'll be doing some workings later. So remember here, you can't say times 6/12 a year. We don't prorate balance sheet figures now, all right? So we go to goodwill, leave that out. Financial assets, we have 350 plus 0, like that. So go to current assets. Current assets, what do we have here? Inventory, 6,700. 6,700 plus who? 6,700 plus who? Plus 6,000. Great. Receivables, what do we have here for receivables? 4,150. 4,150 plus 1,000. 4,150 plus 1,000. Then we have cash, like now this is a free mark, 1980. 1980 plus 400. These are free mark. I can only make adjustments to cash if there is cash in transit. If I'm told there is cash in transit in group accounts, cash in transit must be added here because it is not available here. If it's on the road, then the group will be able to see it and put it there. So ordinary share capital, we normally take the one of the parent. Ordinary share capital, we take the one of the parent alone. First of all, put it there. Share premium the same, put it there. Parent only 4,000. Retained earnings, I need a big working for that. NCI, I need a working for NCI. And a working for NCI. We have 8% loan notes. Great. 8% loan notes. We have 7,600. 7,600 plus 2,000. And then we have deferred consideration. I'll do a working for this. Then we have trade payables, 5,500. 5,500 plus 5,200. That's trade payables. Current tax payable is 2,800. 2,800 plus what here? Plus 2,300. So remember, this examiner has given you an income statement and a statement of financial position to confuse you so that you don't get any mark. All right. Remember, by just writing like this, I've spent how many minutes? I've spent 20 minutes to write like that. So how many minutes, extra minutes do I have to finish this? Not finish, but do the question nicely. How many extra minutes do I have? Another 20 minutes maximum. After just copying like this, already 20 minutes are gone, or 15 for your case because you're just writing, gone. So hapo sasa kitakusaidia ni wewe na bidii yako ya kukimbia. Wewe na bidii yako kukimbia. Hebu tuone zile tutakimbiza haraka haraka. Tuone zile ambazo tutakimbiza haraka haraka. So zile ambazo tutakimbiza haraka haraka. Whenever you are given to consolidate a statement of financial position and income statement, most students end up getting nothing because of speed. So ladies and gentlemen, we shall start from the beginning here, and I will be able to read very fast. Very fast. So I'm told on 1st October 2019, H Limited acquired 80% of the ordinary shares in S Limited, when the retained earnings of S Limited were 53.35 million. On the same date, H Limited acquired 40% of the ordinary shares in A Limited, paying 16 per share. The acquisition of the ordinary shares in S Limited was through a share exchange of 1 ordinary share in H Limited for every 2 shares in S Limited. That's very good, but a tongue twister at times can be quite tricky. The market price of H Limited and the S Limited's shares as at the date of acquisition were 30 and 18 per share respectively. In addition, H Limited agreed to pay a further consideration of 25 per acquired share in S Limited on 1st October 2021. So please underline that one is what we call a deferred consideration. So the question is, for this deferred consideration, this will give me free marks normally. This will give me free marks normally. So for deferred consideration, tell me how many shares were acquired? Shares of S. Shares of S acquired. Shares of S acquired. Remember, we acquired 80% times the nose. Number of ordinary shares of S. If you look at the balance sheet of S, you'll be able to see that the S had how many shares in total? 500. S had 500 shares. Because you see 5,000 is the share capital. The share capital, we have a par value there of 10. 5,000 divided by 10. You get the number of what year? Number of shares. So 80% of 500 gives me how much here? How many shares? So number of shares acquired, we call it the norms. These are 400, isn't it? I'll adjust the camera, yes. These are 400, yes. So in this case here, sorry for that. 400. So are we in agreement? Number of shares here are 400 now. The number of shares of the subsidiary acquired. 80% of 500. Because we took 5,000 in the equity. If you look at the equity section, ordinary shares of the subsidiary, share capital was 5,000, but divide that by the par value. So 400 shares. So in this case, out of these 400 shares, we made a promise. We promised to pay how much per share acquired later. Later to pay. How much here? Somebody per share? Later to pay. How much in this case here per share? They are not even talking to me. Later to pay. How much per share? Later to pay. How much per share? 25, isn't it? You pay 25 per share. So times 25 like that. So in this case here, 400 times 25 gives me what here, somebody? So it's 400 times 20. And because these are deferred consideration, I have to discount it. Because it's a deferred consideration, we have to discount it. Fortunately for financial reporting, we'll be given the discounting factor. Discounting factor, like here, they have given us a discounting factor, which is what here, somebody? Discounting factor, which is what here? They have given me the discounting factor. Are you able to see in this case here, payable into, and it has a present value of 83 cents. Anytime you see us being given a figure in cents, you always divide by 100, to change them to Kenya shillings or to whatever. Always divide by 100. So that's the same as what here? 0.83. So this is what we call the deferred consideration. Present value of deferred. Present value of deferred consideration. Which equals who? Somebody here. Present value of deferred consideration. Present value of deferred consideration equals who? 8,300. 8,300. Without wasting time, could you kindly, this is like a loan the parent company has been given. It's a loan the parent company has been given. Please give me the interest in this, what we call unwound discount, but it's interest basically. Give me the interest. So if I come and write here the interest evangelical, if I come and write here the interest evangelical, it's a loan we have given these guys. So if I write the interest, these guys have given me the cost of capital. They have told me the cost of capital is what here? The cost of capital is 10%. 10%. So 10% of 8,300. But again, be keen, because remember in this year, we have only stayed with this subsidiary for how many months? We unwind with time. We've stayed with this subsidiary for how many months? We've stayed with this subsidiary for how many months? 6 months. So this interest is time bound. So you must come and multiply this with 6/12. 6/12. 6/12. So could you kindly give me this? Could you kindly give me this? Could you kindly give me this? So nasema ni 450. Kwa hivyo ukija hapa kwa deferred consideration, hii ni pre-mark normally, unachukua the 8,300 plus this interest and hawajalipa hata hiyo interest hawa kora. 8,300 plus 415. So long as you remember here this interest to time apportioning. You always remember to time apportioning. So this gives me what figure, somebody? What is the deferred consideration figure? What is the deferred consideration figure? Deferred consideration, always do it. Total figure, deferred consideration. Now, what do we have there? 87.15. 87.15. 87.15. 87.15. Usite materms kubwa kubwa sijui ati unwound interest ya kitu gani, unwound sijui nini. Weka hapo interest namna hiyo. So 415, which gives me 87.15. 87.15. Now, where else will I take this 415? Where, because it's interest, I will take it to the finance cost. It's interest. I'll come to the finance cost and put it here plus 415. Plus 415. Don't take a calculator yet here. Still, I'll do some adjustments. Don't take a calculator yet there. Finance cost. Thank you very much. Thank you very much. So at least that I've been. So from there, already I've mastered my way out here. I'll go to internal sales. Internal sales is very, very important. Do we have any internal sales? Note 3. Note 3. After the acquisition, S Limited sold goods to H Limited worth how much? 500. So what do you know in this case here? S and H, these are serious relatives which are not supposed to be selling goods to each other. If they tend to sell goods to each other, then that is fake. So in this case here for fake sales, come and deduct these fake sales from revenue, and you deduct it from who? From cost of sales. So you cram this. Fake sales. Fake sales. Deduct this from group revenue and from group cost of sales. Why from group cost of sales? Because one of the companies said, hey, I purchased. The other one is saying, hey, I sold. Hey, I sold. Goods worth 500. The other one, I purchased. Goods worth what? Yeah, 5 purchases found in cost of sales. Because cost of sales, we say opening stock plus purchases minus closing stock. Minus closing stock. Ladies and gentlemen, remember the next thing that follows here. Whenever you have internal sales, there must be UPS. So is there somebody who is able to calculate UPS for me very fast? Anybody who is able to calculate for me UPS very fast? Anybody who is able to calculate for me unrealized profit on stock? Unrealized profit on stock? Anybody who is able to calculate for me the unrealized profit on stock? How do we get this? It is profit margin times remaining intra-sales. Profit margin times remaining intra-sales. Profit margin times remaining intra-sales. So remember here, the examiner gave you profit markup. He gave you profit markup. He has told us there. Markup is profit over cost of sales. He has given me profit markup in note number 3 as 25 over 100. 25 over 100. So this time around, I want the margin. So how do I get margin? Margin has got a bigger base. Margin has got a bigger base. It will be 25 over 100 plus 25, like that. 25 over 100. Margin has got always a bigger base. So this gives me 25 over 125. So please come back here, or 1 over 5. So 25 over 125 times the remaining out of these 500 units that were sold. What percentage is still left in the farm? Percentage is still left in the farm. They've told us in note number 3 that H Limited had 30% of these goods in its inventory. Yeah, 30% was still remaining. So remember, REIS is not REIS-PAR. REIS is remaining intra-sales. Remaining intra-sales. So is there somebody who has this UPS for me? Is there somebody who has this UPS for me? Is there somebody who has this UPS for me? The UPS. So 25. UPS stands for unrealized profits on stock. Unrealized profits on stock, 30. So once I get that 30, where do I do the adjustments? Where do I do the adjustments? Once I get this 30, where do I do the adjustments? Can say 2 areas, 2 places. Where do I do the adjustments? For cost of sales, you add it to the cost of sales. Add it to the cost of sales, and then you subtract it from where? Because the inventory is overstated now. Inventory is overstated. So inventory, you subtract there 30. Inventory, you subtract there 30. Things are happening. Things are happening there. Things are happening there. Okay. So, ladies and gentlemen, we are through with that. Are we together? I don't know whether you guys are able to catch up with my speed, because this is the speed that I would want you guys to move with. Great. Thank you very much. So we go to note number 1. At the date of acquisition, the fair value of S Limited's identifiable net assets approximated their book values, with the exception of an item of plant which had a fair value of shillings 200 million above its carrying value. The plant had a remaining useful life of 100 years at the date of acquisition. Depreciation on the plant is classified as part of what year? Cost of sales. The fair value of the plant has not been reflected in S Limited statements. No fair value adjustments were required on the acquisition of A Limited. Now, ladies and gentlemen, could you kindly go ahead and give me the depreciation on fair value adjustment there? Give me the depreciation on fair value adjustment. Give me the depreciation on fair value adjustment. In this case here, plant item. I can see a revaluation of 200, isn't it? A revaluation of 200. Out of how many years? Out of how many years? Somebody is able to follow. Out of how many years somebody is able to follow? 10. Is it 10 or 10? Eh? Useful life is how many years? Or is 10? Eh? Useful life is 10. So 200 divided by 10 gives me what year somebody? Gives me 20. But you see, this is a whole year. This is a whole year. This is a whole year's what year? Depreciation. And yet we stayed with this thing for how many months? We stayed with this thing for how many months? 6 months. So times 6 over 12. Times 6 over 12. So in this case here, this gives me what figure? Somebody there? This gives me a figure of 10. So this plant, of course, depreciation of plant, we normally take it where? Where do we normally take this 10? Where shall we take it? Where shall we take this 10? Cost of sales, isn't it? Cost of sales. So in the cost of sales, come the cost of sales is an expense. Add it here, say plus 10. Add it there, plus 10. And then remember that we had a revaluation of what year? A revaluation of a plant item here, which in this case, the revaluation is 200. We decrease the value of the plant, the value of the PPE. And then don't forget to reduce it by the depreciation, which was not accounted for. We are doing very well. 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 I'll be able to finish everything in the next 10 minutes, yes. Not everything, but I mean, I just want to get maximum number of marks. Maximum number of marks. Maximum number of marks. Now, ladies and gentlemen, after that, if you allow me, if you're together, that is, I would want to go to note number. No, I haven't finished yet. So I'm told here, in addition, at the date of acquisition, S Limited, S is a subsidiary, had an internally generated brand, which the directors of H Limited believes to have a fair value of 300 million. So in this case here, we have a brand item there. We have a brand item there, a brand item there. Brand in this case here belongs to intangible assets. So a brand of 300 million. The brand had an estimated useful life of 6 years. Amortization charge is classified as an administrative expense. So then what I'll do, in my non-current assets, I'm going to introduce intangible assets. Don't bring this here. I'm going to introduce intangible assets. I know you guys have good space. You can squeeze this somewhere there. I have an intangible asset called brand, whose value is 300, but of course it has to be depreciated. We talk about amortized, because the 300 is not amortized yet. So, and they've given us, in this case here, we have 300. Number of years are what year? 6 years. So this gives me how much? Somebody here. I'm looking for a amortization. You call it because it's an intangible asset. It's amortization. Amortization. So 300 of it. That gives me 50. 50 again. This is for a whole year because this was on the same date. It's for a whole year. So 60 times 6 over 12, which in this case here will give me how much, ladies and gentlemen? 25, right? 25. 25. 25. So, ladies and gentlemen, I will come and reduce this brand value of mine, 25, 3 marks really. And they have told me that this 25, of course, intangible asset depreciation, you can't take it to cost of sales. I've been told that this is supposed to be classified. This is classified and administrative. So come to the administrative cost and add 25 here. That's what they've told us. If you look at this statement here, they've told us amortization charge is classified as an administrative what year? Expense. Administrative expense. Somebody may start arguing that internally generated assets are not supposed to be captured. I agree. But you see, this is for the subsidiary. So it is the parent which is trying to do what you to recognize it. So you have to recognize it like that. And remember to depreciate it, amortize it, that is. Amortize it like that. So can I go to something different? Can I go to something different? Can I go to something different? Oh, yes, sir. So we go to note number 2. We go to note number 2. Immediately after acquisition of S Limited, H Limited invested in shillings 250 million in an 8% loan note of S. So H gave S a loan of how much? 250. That loan, what do you know about that loan? What do you know of that loan? What do you know about that loan? That is a fake loan. It's a fake loan. How do you give your son? How do you give your son a loan? That loan is fake. That loan is fake. Do we know, or do we, in this case here, come and adjust our loan notes? We must adjust our loan note, isn't it? Because you see the parent had, in this case here, accounted for it. You must come here and say, hey, this loan note is fake. Minus 250 there. You say, hey, the loan note is fake. Are we together? Are we together really there? It's like I've lost some of you. Are we together there? The loan note is supposed to be subtracted there. And again, if there was a loan note, there must be interest on the loan note. There must be interest on the loan note. Thank you very much, Joanne. There must be interest on the loan note. So is there somebody who can give me this interest on this loan note? Is there anybody who is able to give me interest on the loan note? Anybody who is able to give me the interest on the loan note? Interest on the loan note. Interest on the loan note. So interest on the loan note, we know the figures here. We know the figures here. It is 8%. 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 So it is 8% of the total loan, which is what year 200, what year 250. 8%, 8% of 250, which will give me how much? Now they are not talking to me. Now they are not talking to me. Now they are not talking to me at all. For reasons that I don't understand. For reasons I don't understand. So in this case here, the annual interest will be 20. But now remember, we stay with this thing for how many months? 6 months. So which gives me an interest of what here, somebody? Interest of how much here, somebody? Interest of 10. Interest of 10. So the interest of 10. So then, ladies and gentlemen, what do we do with this interest of 10? That interest of 10. So remember here, read the question again. Read the question again. This is quite confusing. We are told here that H Limited had 30%. No. Immediately after acquisition of S, H Limited invested shillings 250 million in an 8% loan note of S Limited. So, ladies and gentlemen, who had this loan? This is a loan, you know, the parent company has only bought the bonds, but the loan instrument, the loan belongs to the subsidiary. It is a subsidiary that is paying interest. The subsidiary is paying interest. So then you need to come to the subsidiary's finance cost here. This 150 has to be, I wish I had a bigger space here. But you guys, I wish I had a bigger space here. I wish I had a bigger space because I know what the students will do. The student will come and they say, yeah, minus 10. No. If I say minus 10, it means that it is the parent that is paying. Here, it is the subsidiary itself that is paying that money. Subsidiary that is paying this money, 10. And which is fake. So I need to come to this 150 here. I adjust it. The 150, I'm supposed to reduce it with 10. So this is supposed to be 100 what here? This is supposed to be 140. Because you see, the parent company gave this subsidiary a loan. Who is paying interest? Who is paying interest? The person paying interest is a subsidiary. So it is the subsidiary's interest that will be reduced. It is the subsidiary's interest that will be reduced, and you can cram it that way. It works like that throughout. It works like that throughout. Don't adjust it. If you say you're minus 10 at the end here, your mathematics will not be correct. Your mathematics will not be correct. Your mathematics will not be correct. Now, ladies and gentlemen, then what I will do, I will come here very fast. Look at the next note. 4 is talking about non-controlling interest. That will be captured later when I do the goodwill and whatever. Then we have note 5. Impairment tests were carried out on 31st March 2020, which concluded due to poor trading performance, the investment in A Limited had impaired to the extent of 80 million. So we have impairment loss here. Now, let's agree. This one here, which profit do you share? You know, there are 2 methods here. Do you normally share in your normal class? Do you normally share the part of the associate or the PBT of the associate? I tell you something. Which one do you normally share out? Is it PAT or is it PBT? Which one do you normally share out? Or it's PAT? Then if it's PAT, it becomes very easy, even for me. So in this case here, share of profit after tax of the associate. Here. Share the part. Share the part of the associate. So in this case here, part of associate. So part of associate. So part of associate, what do we have here? These guys have given me They have given me, what have they given me here? They have given me the income statement of part, the income statement of the subsidiary, associate, I mean. Are you able to see the part of A Limited? Part of A Limited, are you able to see the part of A Limited? These guys are not talking to me at all. Are you able to see? So remember this part, the part, I have to rub this for me to demonstrate this even better. I just have to rub this. The part there, ladies and gentlemen, is minus what here? It's minus 600. This minus 600, remember, is our whole year's profit. And this associate, we bought it together with the subsidiary, same date. So the associate, we have also stayed with this associate in the year. You've stayed with it, I mean, for how many months? For 6/12. And if you recall very well, this 600 is for everybody. But I want to recognize just my share. So in this case here, my share percentage is how much. There's somebody who is able to see the share percentage. How much, what percentage of A do we own? 40%, 40%, 40%, 40%. And out of this profit, ladies and gentlemen, that you make, if there is any impairment of the associate, then, ladies and gentlemen, you must, in this case here, deduct out of the profit you take here, you must come and deduct the impairment in the associate fully. Remember, impairment in the associate, you can't apportion it with 40%. Because impairment of the associate, you as the parent is the one who will go and just look at your figures only. Look at your figures. Say this investment that I have in the associate, ladies and gentlemen, has been impaired by 80 million. So minus 80 here. Like now, this is normally a free mark rate. There's no reason. There's no reason here. Number 6, S Limited paid dividends amounting to 400 before the year end. I'll even ignore that for now. All incomes and expenses, ignore that one. Other than the share exchange in acquisition of the ordinary shares in S Limited, there were no other issues of ordinary shares by the group companies. So then do me a favor now, nikifika hapa utasatafuta goodwill. Sasa wewe weka hizi figures zote. Piga hizo figures zote. Apart from this, I'll be doing this later like that. I'll be doing this later like that. So a student who reaches there, ladies and gentlemen, don't you think this is a very bright student? A student who is able to do up to there. What do you think? What do you think? What do you think of this student? A student who is able to make those arguments. Do you think in this case here, this student, if you're an examiner, you will manage so many marks. And I've given you, like those investment incomes, if I were you, I'll not even think about them. At other places, yes. Because if you look at the marking scheme that I normally give it to you, this guy will end up making so many marks, you'll be surprised. Hata ukipata, for example, like upate 6 kwa balance sheet, na 6 kwa income statement, then you are sorted out. You're sorted out. If you get time, which I'm so sure you'll not get time, I've done this even myself, especially when you're told to do an income statement and a balance sheet, you not get time even to do goodwill. People get time to do goodwill when you are told to do the balance sheet alone. But if they tell you to do income statement, they tell you to do a balance sheet like this, consolidated, trust you me, goodwill and NCI, those ones, you will really waste your time doing them and you can never be correct. When they tell you to do income statement and the balance sheet, you only reach like now where we have reached here. And then after you're punched, others will be wrong, of course. You go to a different what year, you go to a different question, and you'll be good to go. You'll be able to pass. So share of part. What are we getting for share of part? Share of part. So remember, what is the share of part here, somebody? Is it 200? Share of part, is it 40 or minus 200? Let's see the body mass. Let's see the body mass. Let's see the body mass. Somebody help a friend here. Help Wanjiro Yatonga here. Or share of part. Because this figure will be minus, then this is minus 80. What are they getting there? What are they getting there? Minus 200, right? Minus 200. Remember, this is minus because it's a loss. Don't forget, this 600 you are subdividing is a loss. The 600 is good you asked there. The 600 you're subdividing there is a loss. So this is minus 600, that's minus 300 on you. Times 40%, 300, that gives me minus 120. So minus 120 minus 80. Minus 120 minus 80. Then we are able to get what here? We are able to get that. We are able to get that minus what here? Minus 200. We are able to get minus 200. We are able to get minus 200, minus 200, minus 200. Now, for the sake of your exam, just in case they ask you about goodwill, let's just do it for the sake, because at times they tell you, hey, you calculate goodwill, ikiwa peke yake. For the sake of your exam, where they can easily tell you to calculate a few things here and there, individually, then this is what I shall do. This is what I shall do. So if I'm the one and I would want to extend this a little bit, just a little bit, I can see there is a place where they have told me there is share exchange. I'll start it from there. If I would want to extend this a little bit, share exchange. Share exchange. So the share exchange, ladies and gentlemen, then what do I have here? This share exchange, they have told me that I acquired 80%. I acquired 80%, 80% of who? 80% of the subsidiary. So this 80% that I acquired, ladies and gentlemen, it is 80% of 500 shares, which you guys told me these are 400 shares. 400 shares. 400 shares. Now, ladies and gentlemen, they have told us something very nice there in paragraph number 2. The acquisition of the subsidiary shares in S Limited was through a share exchange of one ordinary share in H Limited. So 1H equals 2 subsidiary. 2 subsidiary. And remember, these shares you have computed 80% of 500, 80% of 500, which is 400. These are shares of the subsidiary. So how about 400 for the subsidiary? Then the parent will give out how many shares? So if you cross multiply, it will be 1 times 400 divided by 2, which will then end up giving me how many shares? 200. So in this case here, what is the value given out by the parent? Value given out by the parent. Value given out by the parent. Value given out by the parent. Remember, the parent has given, this is the holding company. The holding company has given out 200. And at the date of acquisition, these guys' shares, the shares of the parent were worth how much? Were worth how much? Were worth how much? Were worth how much? The market price of H Limited and S Limited at the date of acquisition were 30. So in this case here, times 30. So please give me a figure there. So this is the consideration that the parent paid. The parent in this case here paid the consideration of what year? 6,000. 6,000 in terms of share exchange. In terms of share exchange. In terms of share exchange. And then of course we have the deferred consideration. Do you remember the deferred consideration? Do you remember the deferred consideration present valued? Because we're looking at this today. Do you remember the deferred consideration? Deferred consideration was 8,300. 8,300, like that. Was 8,300. Deferred consideration, because they gave 2 types of considerations. They gave out shares, and then there was the money aspect, but the money was to be paid later. The money was to be paid later. Now, ladies and gentlemen, remember, we don't own this one alone. We have NCI at acquisition. We have NCI who have got 20%. So if you allow me, I'll be able to wrap this. These figures will come in handy in the goodwill computation, right? So in this case, here, ladies and gentlemen, give me the NCI at acquisition. NCI at acquisition. NCI at acquisition. Give me the NCI at acquisition. Give me the NCI at acquisition. So NCI, remember these guys took what percent? 20% of the 500 shares. So 20% of the 500 shares, what do we have there, somebody? 20% of the 500 shares is 100 shares. So these were bought by NCI. Bought by NCI. So the ones that were bought by NCI, then in this case here, what is the value? Value. So it will be it will be 100 times the price per share. The price per share. Price per share. Price per share. So you can see, ladies and gentlemen, in this case here that these shares of the subsidiary were valued at 18 at the time of acquisition. So 100 times 18. 100, which gives me hizo figures zote zikae namna hiyo kwanza. Kumbuka NCI, they don't have any association with the price of shares of the holding. You can't tell me that multiply this with 30. No, they don't have any association. That's their business. Holding company's share price, that's their business. As in this case, you're looking at the value of the subsidiary shares as NCI. As NCI. Great. Then, ladies and gentlemen, move very fast and give me the net assets. Move very fast and give me the net assets. So net assets at acquisition and at reporting. At acquisition and at reporting. Net assets of who? Net assets of the subsidiary. Net assets of the subsidiary, remember. So are you able to remember those terminology? So net assets, we normally measure net assets using who? Equity. Equity. And the equity component here, we are looking at share capital of the subsidiary. Are you able to see the share capital of the subsidiary? Not parent. Share capital of the subsidiary. Are you able to see the share capital of the subsidiary? These guys are not talking to me at all. Share capital of the subsidiary. Please look at the balance sheet given. Share capital of the subsidiary. Share capital of the please look at the balance sheet. Please look at the balance sheet given. I'm losing out my question. Look at the balance sheet given there. Look at the balance sheet given there. Share capital of the subsidiary. 5,000, right? So share capital, no missing of words. Same throughout. Same throughout. After share capital, I know the other equity component is known as who? The other equity component will be, ladies and gentlemen, the share premium. Share premium. And again, remember that this share premium is for everything is for the subsidiary and the same throughout. So share premium of the subsidiary 2,500, 2,500, 2,500, 2,500. Do we have any other thing? Oh, yes, we have retained earnings. So retained earnings, you have to be very, very careful. Retained earnings, you must be very careful. So I don't know whether they gave us retained earnings over this subsidiary at acquisition. Is there any place they are able to give us retained earnings at I know at reporting is 6,700. Is 6,700. Is 6,700. Paragraph 1. Paragraph 1. Paragraph 1. At reporting, you see at reporting is what I'm able to read there. At reporting, retained earnings zitakuwa tofauti, yeah? Retained earnings zitakuwa tofauti. Retained earnings zitakuwa tofauti. Now, ladies and gentlemen, you come here and give me, in this case here from paragraph number 1, retained earnings at the date of acquisition was 53 something. The first paragraph. 53.35 years. 53.35 years. Then we have fair value adjustments. So fair value adjustments, we have PPE. PPE, what was the revaluation upwards? PPE, the revaluation was 200. And then there was a fair value brand. So fair value brand. What do we have there for fair value brand? Fair value PPE. Fair value PPE, we have the yes. And then we have fair value brand, yes. So the brand, there was a valuation internally. There was a fair valuation there, 300. So this one goes the same, 300. So then we have a depreciation of the PPE. Are you able to remind me what the depreciation that we have taken the income statement, PPE? How much? Depreciation of PPE, how much? 10, eh? So this one can only come here. You can't put it there. Then we have depreciation, what we call amortization of the brand. The brand, I believe we got this figure somewhere. Was it 10 as well? 300 divided by 650, 25. That comes there. Then we have the last thing, UPS. The last thing is unrealized profits. Ladies and gentlemen, especially if we have got what here, an upward sale, where the subsidiary sells to the parent. If it's upstream, then you must bring it to the net assets. Please remind me the UPS. UPS lego inakuja ngapi UPS? Is it upstream? Is it upstream or downstream? Because if it's downstream, we don't bring it here. Is it upstream or downstream? Is it upstream or downstream? Is it upstream or downstream? They are not talking to me at all. They are now not talking to me at all. Or it's upstream. So if it's upstream, if it's a subsidiary that's sold, then 30 will come here. And that is it. So come and subtract. Come and subtract there. Come and subtract there. Come and subtract there. It's not subtract, but first of all, give me the total here. So this is upstream. Remember, upstream is when the subsidiary, upstream is when the subsidiary sells to the parent company. Sells to the parent company. So you're able to give me the total here. The total here. Are you able to give me the total here? What do we have at acquisition? At acquisition, somebody totals. Somebody totals. Okay, so according to Wanjiru and the KNEC, 13,335. This is 13,335. 13,335. How about this one at reporting? At reporting, remember there are things to be subtracted here. There are things to be subtracted there. So at reporting, what do we have here, ladies and gentlemen? At the end of the day, 14,635. So we have here 14,635. So can you subtract there now? Go ahead and subtract there. When you subtract, whatever you will get will be called post-acquisition profit. Post-acquisition profit, which will be 14,635 minus 13,335, which will end up giving me what figure, somebody? The PERP. Remember, I abbreviate this as PERP. Remember, I abbreviate this as PERP. 1,300. They're giving me a figure of 1,300 as the PERP. The PERP is 1,300. The PERP is 1,300. The PERP is 1,300. The PERP is 1,300. Now, ladies and gentlemen, after you get that, now I expect you to share this. Share this out. This 1,300 must be shared out. Share this out to the parent, the two owners. The parent and the NCI. Share this out. The parent and NCI. So parent is 80%. NCI is 20%. NCI is 20%. NCI is 20%. So in this case here, the parent, ladies and gentlemen, will take how much? The parent takes 1040. The parent takes 1040, and then NCI takes 260. Very good. Now, once I reach here, then, ladies and gentlemen, I will go ahead and give my examiner what we call NCI. You know, we have NCI at acquisition. Now I need NCI at reporting. So I'll come and give my examiner NCI at reporting. NCI at, I'm so sure there must be somebody who has switched off totally. Please, you may go to an exam saying that I will not do a computation of NCI, and then you say required number 1, calculate NCI, and then you start cursing me. That's why I say we extend a little bit. So in this case, ladies and gentlemen, come and give me NCI at reporting very easily. NCI at reporting. So NCI at reporting, what do we have here? NCI at reporting. I have NCI at acquisition. NCI at acquisition. NCI at acquisition. In this case here, we got 1,800. And then you add a share of PERP. Add share of PERP, which is 260. The one you've gotten there. Which gives me how much? Here, somebody at the end of the day. At the end of the day. Monica is among those guys who had said, I will not compute NCI. I can see you, Monica. I can see you, Monica. So then this gives me what here, somebody 2060. So do you know where you'll take this figure? Where are we taking this figure to? If you remember, there is a place where we shall take that figure to. There is a place. Equity. Equity. Under equity, we have a section for NCI, yes. So this is NCI at reporting. NCI at statement of financial position. Take this there, put it there, 2060. Put it there, 2060, the balance sheet, yes. 2016. Put it there. Great. And then now I have goodwill. Now we have goodwill. Now we have goodwill. So this goodwill, this will be full method. Full method, why? Because you're given NCI. All right. So in this case here, we have the parents' consideration. The parents' consideration. Parents' consideration, this guy gave out shares. He gave out shares worth how much? He gave out shares worth how much? Are you able to remember the shares this guy gave? 6,000, 6,000. And then there is present value of deferred consideration. There is a deferred consideration, present value because we are looking at today. We are looking at today. So is there somebody who is able to remember that present value of deferred 300, right? And then remember, there is the NCI's consideration. The NCI's consideration. So NCI's consideration at acquisition, remember. At acquisition, ngapi? NCI's consideration at acquisition, 1,800. 1,800. And then you come under, now you add the 3, you come under less net assets at acquisition. 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 13. At acquisition. Net assets at acquisition. I want net assets at acquisition. I want net assets 13,335. I don't want this total. I don't want it. And some simply come and deduct to get goodwill. To get goodwill. To get goodwill at acquisition. To get goodwill at acquisition. To get goodwill at acquisition. What figure are we getting, ladies and gentlemen? Goodwill at acquisition. Goodwill at acquisition. They're giving me a figure of 27. A figure of 27, 65. 65. No impairment loss. For goodwill, no impairment loss. So this is what I will take the statement of financial position as goodwill. No impairment loss. No impairment loss. I need to adjust my board a little bit. So have you taken that figure there? 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 27, 65. 27, 65. 27, 65. 27, 65. So ukifika hata hapo, siwe ni shujaa. Ukifika hapo, siwe ni shujaa. Ukifika hapo, siwe umekuwa shujaa. Great, 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 great.